The cost of homeownership involves much more than just your monthly mortgage payment. There are necessary and recurring expenses known as carrying costs that must be factored into your monthly budget. Carrying costs run over and above your monthly mortgage payment and are associated with the general upkeep of your home. A mortgage is what allows you to own your home, while carrying costs are what enable you to maintain it properly. Make sure you have enough cash flow set aside each month to cover these expenses. Hi everybody, welcome back to Property Ladder. My name is Kushnaz and I'm a realtor in Toronto. In this video, we'll be going over carrying costs in detail and discussing how much you need to budget for your monthly expenses. Let's get started. First on the list are mortgage payments. A mortgage is a loan you take out to finance the purchase of your home. A mortgage payment is a periodic amount paid to the lender towards the repayment of your mortgage. It is usually paid monthly but can also be made bi-weekly depending on the option that you prefer. The payment made is applied to the interest accrued on the loan and the principal amount borrowed. If you purchase the home with a down payment of less than 20%, your lender requires you to get mortgage insurance, which is added to this payment. The main factors determining your monthly mortgage payments are the size and term of the loan. The size is the amount of money that you borrowed, and the term is the length of time you have to pay it back. Generally speaking, the longer the term, the lower your monthly payment. Second on the list are property taxes. Property taxes are charged by the municipality you live in and are used to pay for services such as garbage collection, road maintenance, snow removal, and more. How much you need to pay is calculated based on the property tax rate and assessed value of your home, which is determined by your local municipality each year. The property tax rate ranges from 0.5% to 2.5% depending on where you live, and the assessed value of your home is established through an official property assessment which is conducted by municipal officials each year. Payment plans can vary and are flexible from annual, biannual, quarterly, or monthly payments. These can be made to the city directly by phone, mail, online, or by setting up a pre-authorized payment plan. Alternatively, you can roll your property taxes into your monthly mortgage payment. With this option, your lender then takes on the responsibility of paying the city on your behalf. Let's look at an example of how your property taxes are calculated. If your home is assessed at a value of $400,000 and your property tax rate is 1%, then your property tax bill for the year would be $4,000. Third on the list is home insurance. Your home represents the most significant purchase you'll make in your lifetime, so it only makes sense to protect it in the event of damage or loss. Home insurance covers your house and its contents against damage, vandalism, theft, as well as if someone is injured on your property. Most lenders will require proof that you've obtained home insurance before issuing your mortgage so they can protect the property they are lending on. Home insurance payments are known as premiums and are paid either monthly or annually. The premium you pay is calculated based on the type of coverage you want and several risk factors, which include where you live, how close you are to the water, your home's construction, to take into account what type of heating system you have, the age of your roof, and the type of plumbing to gauge the probability of you making an insurance claim. And lastly, the value of your home and its contents to determine the replacement cost should something happen to it. The more valuable the house and its contents, the more expensive it will be to replace it. You can obtain free quotes from an insurance broker or online through a multitude of insurance websites to compare coverage and premiums. Fourth on the list are utilities. Utilities is the collective term used for all the services required to run your home, including electricity, water, heating, and internet costs. Utility bills are paid on a monthly basis, and costs for each, especially heating, can vary greatly depending on the size of your home, the number of people living in it, the season, the amount of usage, and the type of heating system that is installed. Getting an accurate estimate of the utilities can be super helpful when calculating your additional monthly costs. If your home is a condo, part of these expenses may be covered by your condo fees. Last on the list are condo fees. If you own a condo, you are required to pay monthly condo fees, also known as maintenance fees, to cover a wide range of expenses. Generally, condo fees will cover part of your utilities and contribute towards the maintenance of the amenities, common areas, and exterior of the condo building. Each month, a portion of your condo fees, along with those of all unit owners in your building or complex, is pooled into a reserve fund, which is to be used for major repairs and renovations. Before buying a condo, the seller provides you with a document known as the status certificate, which details the amount in the reserve fund and how it's managed. Condo fees can vary from building to building, but in Toronto, the average is estimated to be 75 cents per square foot. Your fees therefore vary depending on the size of your unit. The higher the square footage, the more you contribute in fees. Before you decide to buy, determine exactly what is and isn't covered by your condo fees so you know which additional costs you are responsible for. That is it for today's video. I hope you found the information valuable. If you did, go ahead and hit the like button. And of course, hit the subscribe button if you'd like to continue watching videos just like this and learning more about the real estate market in Toronto. Thanks again for watching Property Ladder. See you next week.